Thank you everyone for joining us. We have a great presentation today and a couple of companies pitching at the end. I want to thank Steve Gold for joining us today. He's going to talk a little bit about how to obtain liquidity without selling your stock. So yeah, I guess with that, I'll just pass it on to our CEO, Hall Martin.
Thanks, Shane. Hey guys, thanks for joining us today. I'm Hall Martin, I'm the CEO and founder of 10 Capital. And today we have a good presentation for you guys on finding liquidity for your stock. And I found when I first talked to him, I thought, well, this is a great topic other people should know about. And I found that Steve was a pioneer in this area of structured liquidity solutions, because in these markets, everyone's looking for liquidity options, both the founders as well as VC funds and as well as angel groups and others are looking to see what can we do to find an exit. And Steve's got a great model here to share with us today. So with that, we'll go ahead and have Steve come on up. Steve, thanks for joining us today. Can you kick off and tell us a little bit more about your background and what you do there?
So thanks, everybody. I'm Steve Gold. I'm the founder. We are an early pioneer. We are an early pioneer in the structured liquidity space. Thinking very high level, if you think you need liquidity against an asset, you traditionally you had only an opportunity to sell that asset as the way in which you would obtain liquidity. We felt that for the most successful assets, those that still had significant upside value, it made a lot more sense to borrow against those assets than it did to sell them for a lot of different reasons, and we can go into that as I go through the presentation. But I was working at Citibank at the time, one of the largest lending platforms in the world, and started to get a lot of interest and inquiry related to this. And I brought it to Citibank's management team and said, hey, we should be able to lend money to folks that have privately held stock, but of maturing companies that are doing very well, and they couldn't do it, and that wasn't sufficient enough for me. So I explored other avenues and was not able to find anybody. This is going back to 2010. Was not able to find any firm or group that was willing to provide liquidity without sort of a transfer of ownership. And so I set about to fix that and created a company at the time called VSL Partners, Venture Stock Liquidity Partners. Raised and invested 2 funds there. Decided to create a new company with a very similar strategy, and that was 3Spoke. Just taking a little step back. So what does this look like? Why does one want to go through the complexity of borrowing against an asset instead of selling it? And when we first got started, there were 2 principal use cases. It was option exercise, individual executives receiving options against, for part of their compensation. As the company matures, the cost to exercise those options is going up as the company's valuation is improving, predominantly in tax implications. And we thought that it made very good financial sense to purchase those shares, but it became out of reach financially for a lot of people. And so we thought the original inception of the business would be providing, doing this more for option exercise than it would be for liquidity on its own. And it turns out that the liquidity solution was just as valuable to folks than option exercise. A more recent iteration that I indicate here, a more recent indication, is providing liquidity for venture general partners and limited partners, whereby the asset isn't just the founder shares, but it could be the venture partnership that is also backing that company, backed by a diversified pool of private interests. So that is what we do. Why does this exist, right? And so when we think about the landscape, there are well over 1,000 privately held venture-backed companies. yet to go public. And you can see the progression over the years. The gray boxes are our valuations in aggregate of what we would consider to be, typical venture assets. The blue line is representing any given year's exit. So companies going public, whether it's listings on exchanges, SPACs, or being sold. So exit activity. And the orange is just the delta between, showing that the demand for liquidity, right? The value here, the exits here represents a very significant amount of pent-up demand for liquidity. As companies stay private longer, they grow to become more and more valuable. This liquidity need is only growing and doesn't seem to be abating in any way. As I sort of alluded, what we're providing is financial solutions. I addressed shareholder solutions down here at the bottom most directly. Liquidity in lieu of a sale or for option exercise. But as I mentioned, we structure these for GPs and LPs as well. The principal benefit here is this is a more tax efficient form of capital, while allowing the shareholder or asset owner to participate more in the upside. As you can imagine, if you sell that asset, you pay taxes on that asset, and thus, if you need $1 million and you have $3 million worth of shares, you probably have to sell about half the shares, paying taxes to net that $1 million. So borrowing, becomes very attractive if the asset is still growing, and the better the company is doing, the more this type of a structure would favor the borrow. So when we look at this, because we're not buying the shares outright, so we're not taking as much risk in the sense that we may be advancing 30 or 40 cents on the dollar. We take less equity as part of the economics. We have to do this more at the later stage, the more mature stage. So this is not something that can be done for series seed or even series A mostly. This is generally where we can get involved, is when the company is generating what we consider to be revenue at scale, experiencing high rates of growth. The companies that are very attractive to us are going to be, more high margin businesses, software, predominantly, well capitalized, with typically around 2 to 3 years before the company would be looking to go public or be sold. This is just a quick scattergram of some of the companies in our portfolio. Orange circled logos have already exited. Some of the older ones that you may have heard of: Airbnb, Box, DocuSign, Lending Club, MongoDB, Uber, Pinterest, WeWork. Some of the names of companies that we've done business with. The structure of this. So when you think about a sale, very simple, right? You have, how many shares am I buying or selling, and at what price? When you think about structure, this is kind of a combination of debt and equity. So the idea here is we advance money today, typically against shares that are worth around 3 times the amount that we're advancing. There's a few economic terms. So in a traditional loan structure, you've got some interest, what we call investment return, because our transaction is not debt, it's structured as equity, which has some very good tax benefits for shareholders. And then an equity component, which looks like about 10 or 15% of the pledged shares. Let's think of that like a warrant. But in the example I gave earlier, if If we need $1 million and we have 3 million of shares, we're selling 50% of those shares in order to net that million. So our equity participation is like you're selling maybe a third of the amount of shares that you would be. And that's what makes this look much more attractive when the future upside is strong for the company. You get immediate liquidity today. You retain much more of that upside. There's no tax implications on the money you receive today in a structure like this, unlike that sale. So that's part of what generates that efficiency. And this is non-recourse, or I should say limited recourse, meaning if the company fails after the fact, then there's no return of repayment. So that's a lot less risky for the shareholder than a typical bank debt if you're able to obtain that. Very easy to execute, and as I mentioned, very, very tax efficient. There is no calendar maturity on these. So similar to a sale, you sell the stock and it's out of your estate, it's gone. This, being more like debt, you think, okay, well, there is a settlement that would come in the future. We don't define when that is from a calendar date perspective, because we know that oftentimes you can't control when the company is sold or goes public. Or even if you did control that, you're not going to want to do it because we put a calendar maturity on something. So we're patient investors, and the transaction is triggered to settle following what we call a trigger event, which is typically the removal of restrictions following an IPO or a merger or sale of the business. I probably won't dwell on this because this gets into a lot of the details, but this is an illustration of the value that's generated. So why does somebody borrow versus sell? So this is the example where somebody had $3 million worth of shares. They needed $1 million in liquidity. If they sold those shares outright today, this is this grayish blue bar at the bottom, they would net about $2.1 million net of tax. And regardless of what the future value of the shares does, that's what they have. If the value goes down, they are better off having sold the shares. Makes perfect sense. But if the value of the shares is appreciating 50%, 75%, 100%, if it's going up in value, if you have sold your shares, you get no further participation. So here's where doing something a little bit different benefits you. This first blue line is a transaction where maybe you sell some of your shares in order to achieve that liquidity. And in my example before, that was 50%, about 50% you sold. So yeah, you're going to continue to participate in the upside, but you only have half the shares left. So your participation is going to be, in this range, which is significant improvement over having sold the stock. So yeah, if you're bullish, you hang on to it. But the orange line is the graph of what it looks like, where you're retaining, 85, 90% of that upside, because our structure doesn't require you to sell even 50% of your shares. It's much lower. So the better the company is performing, this delta is increasing and is very meaningful in terms of savings. This is the same example for option exercise. So additional value that's being realized for having borrowed to exercise your options versus either selling some of them or even just deferring and waiting until the company goes public and doing it at exercise. And then I'll just, to be sensitive to time, just close out with a couple of very high level, sort of value propositions. So why we do this on the 3Spoke side, we do this because we want to invest in leading technology enabled companies. We want to do it in a way that mitigates risk. This is a very challenging asset class to invest in. So if we can do it in a way where we can mitigate some of the downside risk, the risk of failure, that's going to be very favorable to us. Also, one of the biggest hindrances to getting secondary transactions done is access to information. And a typical secondary buyer, if they're not an institutional investor that already has knowledge of the underlying companies, it's very difficult to obtain information with which to make a rational investment decision. The flip side of this is, and the companies have to approve the sharing of that information, right? They hold that information very, very closely. Well, in a structured transaction like ours, the seller is not actually selling. It may be a current employee, maybe a current executive that's looking to leverage their shares for either to buy their shares or for maybe a personal investment, but without a sale. And that is that's very attractive to a company relative to its employees selling stock outright. And so we have found that companies are much more open to being willing to provide information if that's the use case of the financing. If somebody is looking to make a personal investment, but just not selling their shares, but using them as collateral. Similarly, if the shares are being sold, that can have pretty significant impacts on the company's fair market value, its ability to issue options in the future at a good, attractive rate. So that's important from the company's perspective, no impact on fair market value. The option exercise is non-dilutive financing for the company as well. So there's actually some benefits to this kind of a structure relative to folks selling in the secondary market, and that further enhances companies' willingness to partner with us and provide us information, which allows us to do multiple transactions with any given company. So we come in, we do our diligence, we structure these, and oftentimes we're doing this for multiple counterparties at the same company. And then, as just reiterating what I had mentioned before, doing this for the employees, the benefit here is immediate liquidity. There's no current tax. You get to participate in more upside. That's the whole point. You borrow against an appreciating asset, you sell a depreciating asset. The recourse is limited just to the value of the shares. So if the company falters, there's no amount that needs to be repaid. So it's a good financial risk from that perspective. And on an option exercise, you can convert an unfavorable income tax treatment on gains into a more favorable capital gain treatment, long-term capital gain treatment, which in many instances in option exercises, the tax savings pays more than the cost of our financing. And so it's accretive to individuals who have low basis options to exercise. And I think that's, I guess I did allude a little bit earlier, traditional lenders, why not go to a bank? Why not do something, more simple types of financing? And most banks are going to tell you that they can't accept privately held shares as good collateral for this kind of financing. If you have other assets that are liquid, you can post those as collateral, but the traditional lender is not gonna lend money against these assets, and they're certainly not going to do it on a limited recourse basis. They're going to want you to pay it back even if the company doesn't do very well. What else? Private asset owners are not necessarily looking to grant guarantees on other assets. So similar idea. And I think I alluded to the other points here. A more attractive solution relative to a sale.
Great, Steve.
Yeah, so that's.
We have a question from the audience. I'd like to go ahead and move to that now. It's a great presentation, Steve. Appreciate that. Joe Milam, you have your hand up. If you would like to unmute and turn on your video and ask the question, you're welcome to do that, or you can type it into the chat box. Either way. Joe, what's your question?
Yeah, the chat box isn't, it says it's disabled. Otherwise I would have typed it in there. So
Oh, okay, we'll fix that.
yeah, two questions, Steve. This is really neat. Is it only on underlying securities, or will you finance the GP's interests in the carried interest or the fund itself? And then secondarily, have you modeled that options exercise over a holding period to qualify for the QSBS, the 1202, where you get the tax-free window?
Yeah, so two good questions. So let me take the first one. GP carry advance, I think, is what you're alluding to, Joe, where an individual who has a general partner interest in a fund, their economic incentive comes from profit participation as the portfolio matures and distributions are made. Once LPs are made whole and typically a preferred return is reached, then the general partner is going to participate. It's typically at 20% or something, in that order of magnitude carry. So we will provide carry advances against the future implied carry of a portfolio. So similarly to a founder that may have to wait 3, 4, 5 years before their company exits and they monetize their shareholding, similarly a GP in a venture fund is going to have to wait, typically at least 6, 7, 8 years before they're going to start to receive carry. We typically can come in right around that 5 or 6 year period of time where the portfolio has matured enough where there's line of sight to some real net asset value, and we can start to model what that carry would look like and utilize that as collateral, and the structure works exactly the same way. So the first monies that would come to the GP for carry would come to repay the financing to us, and then anything above that, the GP is going to participate in, 80-85%, and we're going to participate in an ongoing balance. On the option exercise, if I understood the question correctly, the QSBS exemption is fantastic. I recommend all startup founders be very, and employees be very knowledgeable about the QSBS exemptions, because the ability to defer, not even just defer, but offset tax liabilities up to $10 million of gain, that is hugely beneficial. What I would say is, if you can do that, that is going to make a sale relative to a borrow. You're still going to lose and forfeit future upside, but the tax implications of that sale aren't as detrimental. So in my example earlier, you had to sell $1.5 million of shares to net $1 million of liquidity. So that extra amount of shares you're selling, 50% versus 33%. In a QSBS situation, you wouldn't have to do that. So that levels the playing field a little bit when you compare a sale to a structured financing, but it still doesn't overcome the fact that if the company's value goes up 3, 4, 5x following that sale, there's still appreciation that you would be forfeiting if you sold. So it does change the math a little bit, and our models do account for that. But that's sort of a high level, hopefully I answered your question, but a high level view of it.
The question was around the options, because exercising option, doing the A3B election and going long the stock, you're now starting that 5-year clock ticking. And so
yes,
that would be
yes,
an interesting motivation to borrow money to use your service and to exercise your options.
That's correct. That's sorry if I didn't catch that particular nuance, but that is right. So similarly in our transactions, there's no constructive sale. It establishes the holding period. You own the stock, and begin that clock. That's correct.
Thanks.
Great. Thanks, Joe. Our next question that comes from Chris. Chris, if you want to turn on your microphone and ask your question, and then after that, we'll go to Rick.
Sure. Yeah. Do you ever run into the by the way, a really great idea and really great execution. I'd like to talk to you separately. We run a VC out of Newport Beach. But yeah, the question that I have is, do you run ever into this scenario where the actual agreements that the employees and or shareholders entered into will prevent you from borrowing against it?
Yes, in almost every case, the restrictions that are placed on shares, and I'm glad that you bring this up because it's sort of counsel I want to give to all the startup founders out there to ensure that your stock plans and the stock paperwork would permit founders and employees for being able to do something like this. But yes, the restrictions on stock typically fall into two categories. They are either a transfer is permitted subject to a right of first refusal,
right,
or they are permitted only subject to board approval, right? And I would say as a founder of a company, don't let your board have that much power. Allow for a right of first refusal, not simply a board approval, because you're putting all yourself and all your employees into a position where your interests are now run counter to the board's interest. So that's just a bit of advice there. But yes, those restrictions exist. Some companies will have a carve out. Most companies will have carve outs in their restrictions for bona fide family transfers and estate planning purposes and death and things like that. There's another carve out that we do see in a minority of cases where a security interest is permitted on shares, but that's maybe that's 1 or 2 in 10 where we see that carve out, but it does happen. But where there is no carve out, what we will typically do, as I alluded to earlier, is we're working with the companies. And if the companies are willing to provide us financial information, oftentimes they're willing to waive the restrictions. Or if they go through a ROFR process, we just simply permit, we submit our term sheet that we execute with the counterparty to the company as notice under the right of first refusal and transfer restriction language. And then the company typically has 30 days under which they can exercise that right. I've done this for 10 years. We've done over 80 individual transactions, and we've only had one time did we have a ROFR be even partially exercised. And that was not by the company, that was by one of the company's investors who thought what we were doing was really interesting and they wanted to participate. But the ROFR being exercised on a purchase and sale happens very regularly. The ROFR happening on our structured types of financing is, as I said, 1 in 80. And that's partly because, think about what that means. That means the company has to create a security interest in its current management or employees' shares or former employees' shares, and then have that be an obligation that's outstanding. That's never a very favorable position to be in. So it doesn't occur very often.
Yeah. Do you feel comfortable to talk about some liquidation scenarios? I.e., because you said earlier that if the company fails, you basically forfeit the money that you lend.
Yeah, so we've had that happen in our history. 80 some odd transactions. We've had 2 investments where the underlying company has gone bankrupt or failed, and we wrote the transaction off from on our books and didn't seek any further repayment from the counterparties. So it's rare, thank goodness, but it does happen, and we that's sort of the risk that we take, but it's pretty rare.
Yeah. Hall, I have a lot more questions, but I'll schedule a separate call.
Okay, thank you so much for that. And we do have a question in the chat box from Rick. If an insider in a public company takes a loan against their stock holdings, will they need to file a Form 8K?
If the insider of a publicly traded company.
Right.
So we don't do this with publicly traded companies. I mean, we have positions with publicly traded companies in that 180-day period between when the company goes public and when the lockup expires and then our settlement is triggered. But this is an arm's length transaction from the company's perspective. So the company has no obligation to file anything as it relates to its executives, borrowings. It's sort of consumer, it's almost like a consumer loan, if you will. So there is no if the company was providing financing to its executives, that is under Sarbanes-Oxley rules. That is a note that has to be made in the S1 and elsewhere where there's where the lien holder is the company. But the company is arm's length in these transactions. So even if it is a Section 16 insider, there is no reporting obligation.
Great. Next question comes from J.R. Guerrero. J.R., what is your question?
Hi, Steve. I also would like to speak to you offline on a couple of different things there. So if you want to put your email in the group, or I don't know how we get your email, but that'd be great, Hall. So question here. Oh, got you. So question here. Do you do this for a company that's slated to go public in 2 months, 3 months out, and they need bridge loans? Do you structure it in that respect, where say the main principals would be able to put up their stock and then you would get paid back just like you would do a traditional bridge loan?
It's a really interesting question. I mean, we bifurcate the individuals that would be putting up individual shares from the company who doesn't have individual shares. I mean, they have treasury stock or they can make their own guarantees, but traditionally that's going to come in the form of bank debt. Because you're gonna post the company's assets as senior secured. What we're doing is more on the individual shareholder side, and we're not really structured to provide that kind of bridge financing. We have done individual transactions with shareholders where they've looked for a bridge. Like, our company is entertaining being acquired by a SPAC, and I'm going to get subject to a 180-day or 365-day lockup. I'd like to borrow some money now so that in the event the SPAC doesn't do well or the lockup, I need some liquidity now. I don't want to wait a year. We can do that, but once the company has gone, is entered into a transaction to go public, we're typically not involved at that point anymore.
Okay. All right. So yeah, I have a couple of different interests that I'd like to speak to you about further. I'll shoot you an email.
Fantastic. Look forward to it.
Great.
Thank you.
Thanks, guys, for the good questions. Let's go ahead and wrap up at this point, and then we'll have our presenters come on. As we do that, Steve, what's the best way for people to reach you? We can also make email introductions as well, but what is your email address there, Steve?
I have the email up on the screen here, steve@3spokecapital.com. My phone is also there as well. So please feel free. You can reach out, connect with me on LinkedIn as well. But the quickest and easiest way would just shoot me an email at steve@3spokecapital.com.
So we'll make the recording and the presentation slides available to those who attended today, and encourage you to follow up with Steve directly afterwards. We'll include the email and the phone number so you can reach out to set up a time to talk with him as well. Great questions. Thank you so much for that. We have 2 presentations for you guys today. We'll do about a 5-7 minute pitch each. Ask you if there are any questions, we'll take those, and then we'll wrap up a few minutes before the end of the hour. So first up, let's have Rick Schumacher come on. Rick, if you want to unmute and turn on your video, love to hear your presentation here. Whenever you're ready, go ahead and kick off, and let's talk to the audience about this.
So Pressure Biosciences, if I can, we are a publicly traded company, so of course I need to put my forward-looking statement up to make my lawyer happy. I'm not going to go through a lot of detail here, just a little bit about myself. I spent 13 years as a scientist at Harvard Medical School working in virology. I started 4 publicly traded companies. The first three were valued total at about $1 billion that I either founded or co-founded. And I'm on my fourth company now called Pressure Biosciences. And again, I would ask, we're on the OTCQB, by the way. All four companies were on the NASDAQ. This company, we were on the NASDAQ until our stock fell below $1, and we've been on the OTC, but we've made it very public that we're intending to uplist in the first half of next year. We have 30 issued patents in 3 technology platforms. The only one I'm going to talk about today is the one on the bottom, Ultra Shear Technology, or UST, where we have 7 patents that feed into multiple multi-billion-dollar areas that we'll talk about briefly. First of all, I need to talk about emulsions because our technology works with emulsions. Emulsions are mixtures of 2 or more liquids that don't mix together. They're immiscible. Basically, like oil and water, you put them together. A salad dressing, most salad dressings are emulsions. If you think of your raspberry vinaigrette, it sits there for a minute and it settles out into 4 or 5 different levels. Many pharmaceuticals, vitamins, supplements, nutraceuticals, cosmetics, agrochemicals, foods, beverages are all emulsions. We run into emulsions, thousands of emulsions in any given day, week, or month. The problem is that emulsions generally have poor water solubility, poor stability, and poor what we call bioavailability, the ability of that significant agent that's in the oil to get out and get into the body or into the plant. Poor bioavailability because they're in oil. We're water-based. Humans, animals, plants are water-based, and therefore we don't absorb active ingredients out of oil very well. The solution going forward is to make the emulsions what we call nano emulsions, where the oil droplets are down to nano size. They're actually smaller than the size of a bacterium. So this is a picture of astaxanthin. Astaxanthin comes out of algae and krill. It is a very powerful antioxidant. It's 6,000 times more powerful than vitamin C. It is sold as a supplement all over the world, and it is in oil. And therefore, if you look in the middle part of the slide, you can see that the oil and the water, if you let it sit there, will separate out. What we've done is developed an instrument that passes through our instrument 5, 6, 7, 8, 10 times, and we break the oil down to the nano levels. So instead of having an oil drop, we have hundreds of millions of tiny little nano-sized oil droplets. What happens when it becomes a nano emulsion, when the oil effectively goes into water, it becomes clear, it becomes increasingly long-term stable, and it becomes very bioavailable. Therefore, the body can absorb, in this case, the astaxanthin out much more efficiently. So you go from less than 20% generally of bioavailability of the active ingredient in a regular emulsion to over 80%. So imagine you're taking a vitamin D3, you're taking a vitamin K, you're taking astaxanthin or curcumin as a supplement, you're using CBD, you're taking prednisone on a skin rash. All of these are in oils, and you're getting very little of that active ingredient. If you nano emulsify that material properly, you should get a much more effective absorbance. So this is CBD. The only graph I'll show, basically, you can see the size of the oil starts at the top left around what we call 250 nanometers. So it's 2.5 times the size of a bacterium. And as we put it through our machine, as we shear the oil, shear it lower and lower, it gets down to about 50 or 60 nanometers. And what happens is the clarity on the right side goes up. So something that's really opaque in the beginning becomes very clear as a nanoemulsion. So again, we're doing this to increase the absorbance and increase the ability of the body to absorb the material. The one on the left was done using a regular homogenization method. This is CBD oil. The one on the right is that same sample put through our instrument. About 15 minutes later, it's become clear. It's still got the same amount of oil. It's still got the same amount of CBD in it, but the CBD in the oil is so small that light goes through it and it becomes transparent. And by nature of being a nanoemulsion, it'll be far more absorbent. This, if you take a true nanoemulsion and you put it in water on the bottom set, you can see putting our CBD in water, it disappears. On the top, we bought many different samples of water-soluble nanoemulsion CBD, and you can see what happens. It goes back to being a milky solution. We've done CBD, THC, astaxanthin, curcumin, retinol, which is in cosmetics, neem oil, which is a natural insecticide, algae oil, and prednisone. We've yet to find an oil-based molecule that we were not able to nanoemulsify that oil. So we're very excited about this. The number of applications, think about all of the nutraceuticals, all of the cosmetics, all of the agrochemicals, all of the pharmaceuticals that are where the active ingredient is in oil. 44% of all new drug candidates are in oil. We've got to be better at, more efficient at getting the active ingredient out of the oil by nano-emulsifying it, which is what we do. We think we're best in class in the world. We have reasons to say that, which I can't say, but I could under an NDA. If anybody would like to contact me under an NDA, I can tell you why we believe we're best in class in the world. We've had a lot of news lately, which I don't have time to go over. I think the most important thing, though, is that we've taken a pivot. Even though we have 30 patents in 3 areas, we're putting 95% of our effort into ultra shear technology. And we started in January. We've been working on this for 6 years, saying that we're going to commercialize in the 4th quarter. Well, guess what? It's the 4th quarter. We're very excited at Pressure Biosciences right now because we expect to ship our first shipment of nano-emulsified CBD to a customer in which we have a contract that we believe next year will generate $1 million. We have 2 other contracts that we believe will generate $1 to $2 million. And it's all going to be done for next year, but we're going to be doing pilot runs this year. My last slide is outside of the CBD field. We signed a contract with Dr. Denese. She's an MD, PhD. She has one of the most successful skincare companies ever in QVC. She sold $500 million of product. We signed with her about 3 or 4 weeks ago. We're already starting to work with her. She has fantastic products, but she knows that they could be made better if they're made more water soluble. So we're working with her. And we look to have products with her out on the market by 2023. Paul, thank you very much.
Great. Thanks, Rick. Appreciate that. We'll connect you with any investors interested afterwards. Does anybody in the room have any questions for Rick? Just 1 or 2 that we can put in there. Let's see, one quick question coming up here. Are you raising a PIPE, P-I-P-E?
We're not raising it. We've done pipes. We're not raising a pipe, but we need cash for our launch. So if anybody's interested, because I'm a publicly traded company, I can't talk about or advertise anything about anything that's not already out there in the market. So I'd be happy to sign an NDA and talk to any investors that are listening that might be interested in learning more. Great.
We'll canvass the investors afterwards, Rick, and get back in touch with you. Thanks for that. And with that, let's switch over to JR Guerrero of Ninja. JR, can you switch on your video and show your slides, and we'll kick you off as well.
How are you? Hi, everybody. I'm the JR Guerrero, CEO of Ninja. And I'm going to show you my thing. I'm going to shut my camera off just so I can focus on the slideshow. Okay, so what is Ninja? Ninja is FinTech meets integrated workstream collaboration. So if you think about what people are doing in this world nowadays, they're basically connecting with people, showing a skill set. They're content creators, they're influencers, and they want to get paid for their skill sets. That doesn't happen very easy unless you have millions and millions of followers. So what we've created is a collaboration suite with an experienced veteran team in tech. And I go through the 3 different people, which I could dig into more later on. And we've seen the problem. There are 1 million of content creators that have a hard time capitalizing unless they're using advertising as a medium where they're getting paid from their YouTube, their Facebook, their Twitch channels, whatever they do, but they really need to have millions of followers to really make a living from it. So what we're doing is we're integrating a payment platform, a global payment platform. So I mean, it can be traditional credit card payments, PayPal, and crypto as well. We have that built into our platform. So what that enables people to do, it enables you to go to the, if you guys remember years ago, the 2, 4, 7, and 11 networks had free TV, and basically they had advertisers pay them. That's how they made their money, and they would force the advertisements on the people for watching the content. So a little company says, listen, we want to come up with premium channel where there are no advertising going on here. We just want to sell you the content and you pay us a subscription. So that little company was HBO. So this is the same premise. We want anybody, whether you have 100 followers, 1,000 followers, 10,000 followers, to be able to put up content and get paid for it. So our Ninja SaaS platform works out of the box. No programming. You just basically create a free account. You're able to put up the payment platform, put up your content, invite people to the group so you can use your Facebook, all your free social media channels to advertise your paid content and say, come to Ninja. Here is a paid content. I could deliver you content. You don't have to have any commercials or watch any of this advertisement. And Google's not tracking you. Facebook's not tracking you. Here is our group, our channel that creates a monetization process for content creators. And it's very simple. It's very easy. You don't need any skill sets to do it. It's like a chat group. You open a chat group, you invite people, you monetize on your content, and I'll show you that in another minute. So pretty much you create a group and you have the ability to create that group as a paid group. If it's a special VIP group, for instance, we're working with or doing a paid group for Wesley Snipes. He wants his group to be paid. So in order to get into his group, he sends you a code. He sends you the QR code of the group, and then you hit the group, and then it asks you to pay a monthly fee. In most people's cases, content creators, you create a free entrance group right here, free entrance, and then you could later on put individual content in there, and that individual content could be charged. You could charge people a cost to download that content. So basically they'll watch 30 seconds for free. If they like it, then they'll hit the paywall and they'll be able to purchase it, download it, or watch it, stream it. So basically it comes up like this. There's my paid content group. I could go in here for free, but I could also buy the content. So the use cases are just what I said, content creators directly to their viewers, their people in their groups. And you can do that as easily on mobile as on computer. So you don't have to get home. If you're out there and you're filming how you tuned up your carburetor and it's on your phone, you don't have to upload or download anything into a separate program or into your computer. You just hit that wheel and you post it. And you post it for pay or you post it for free. It's just done instantly. So our platform monetizations are twofold. One is a subscription, which is a nominal subscription monthly fee, and then 18% on anything that people monetize. So if I sell, if I'm a guitar teacher and I'm selling my lesson for 20 bucks a month or 20 bucks a lesson, then Ninja gets 18% of that transaction, and we get the transaction fees, and that would be on a case-by-case basis. So if I put 4 up in the week, Ninja makes money on all 4. If I put 1 up in the week, Ninja makes money on just that 1. So the market, 104 billion addressable market. Our technology stack is hands down a stack that brings the collaboration suite in for sending large files and content creation, content services for content management, and then of course all the video conferencing and all the things that we've come to use, like we're doing on Zoom. I can screen share with those people. I could teach them how to build Excel sheets. So my content could be anything. It doesn't have to be a movie. It doesn't have to be a guitar teaching. It could be a one-on-one session with someone that wants to learn how to build an Excel sheet, a formula, a certain formula. I could be teaching somebody Xero or QuickBooks. Whatever I want to do, I can charge in the Ninja group. So I'm getting close to my 7 minutes, and I want to just show you the subscription growth has been there. We're on target for $1 million in revenue. We do have 4 or 5 major companies in the pipeline that we're doing a pilot program with right now. And company milestones, we've got our HIPAA compliance, our SOC 2. So if you're doing some kind of selling your telemedicine or your therapy and you're an individual therapist, you could actually sell your therapy through our platform because we are HIPAA compliant. We've raised 11 million to date. It says 6.3 million there, but we're at 11 million to date that we've raised already, and we're looking for 3 million more. And here is the tranches that we've raised the money in. So that's our ask.
Great. Thanks, JR. Anybody in the audience have questions, please post it in the chat box and we'll answer those. We're getting near the end of our time. Appreciate everybody being here today. And JR, thanks so much for the presentation as well. We'll see if we get a question here in a moment. My question, JR, is as you go forward, you know, the creator model is a very, very popular one right now. Everyone's trying to get back to funding the creator itself. How is this going to help the creator in the sense that how much money is going to go back to them versus the partners that were in between the creator and the user? What kind of return is the creator going to get out of this?
Well, the creator is going to get everything but our 18% cut. So there's no advertising dollars. There's nobody taking money out, you know, unless they're using, if they use crypto, they're going to get it all. If they use a traditional credit card, I guess the credit card is going to charge you that 3.5%, 4% fee. But they could set the pricing in there based on those fees. So they could charge that extra, say 20% more, right? So now they're getting what they want to get at the end of the day, and they have that buffer in there for the percentage of the transaction fees.
Great. Well, appreciate that. We'll connect with any investors afterwards that have interest. We'll check everybody on this. With that, we'll go ahead and close out the presentations today. Thank you guys for coming. Thank you, JR, for your presentation, Rick, for yours as well, and Steve, thank you for your content presentation there as well. Appreciate everybody coming, and we'll make the recording available with the contact details as well for everybody tomorrow for all those who attended today. But appreciate you guys joining us today, and with that, we'll go ahead and wrap it up.
Thank you.
Thanks very much, all.